My name is RJ Kelly, and I'm founder and chief visionary officer of Wealth Legacy Group. We're a diversified planning group in San Diego, California, but we got clients in 23 states. And one of the reasons we have clients in 23 states and growing is because of an idea you're going to hear more about today. Not that the concept is new. This has made, for a number of my clients, made them multi-millionaires. But it's something that, as a culture, we kind of are in love with this particular area of real estate. We need it for a variety of reasons. In fact, last year when my wife and I, when our house was flooded, we had to go move things into storage for 4.5 months while our house was getting rebuilt. So the question, though, is to whom do you go for this particular niche? Well, especially with the investment market melting down right now in stocks and bonds, the major question I'm sure on many people's minds is, where can we go as an alternative to generate income and or capital growth, and something that is perhaps a bit more stable and predictable? So that's what we're going to talk about today. And fortunately for me, I have access to a group, pun intended, called Access Capital. Access Capital, like I, does a great deal of due diligence on a number of these different sponsors across the country in different areas of expertise, some oftentimes in real estate, but in other areas as well. And so fortunately, several years ago, I had the great privilege of getting to be introduced to Access Capital, and especially one of their senior vice presidents, Pusiri. And so I'm going to let Sly drive it from here, because he has somebody that we're all going to want to meet. And so, but I'll give a quick shout out to Bill Leitner. Bill, thanks for being with us, and just so excited about what you're doing and what you're going to share with us today. So Sly Pusiri from Access Capital and Bill Leitner. Bill, great to have you with us.
Thanks, RJ.
Yeah, thank you so much, RJ. I'm Sly Pusiri with Access Capital Group, and on behalf of everyone at Access Capital, we are extremely thrilled to have Bill and Lightbox Self-Storage Partners as a partner of ours. It's something, as RJ mentioned, I mean, we've seen the development of self-storage really grow into being a core asset class within commercial real estate. So we were thrilled at the opportunity to partner with Lightbox. Bill himself brings 25 years of commercial real estate experience. He started with retail acquisitions and development, helping develop names like Target, Ulta Beauty, Publix Grocery, Dick's Sporting Goods. His firm even received the Grand Slam, which is a perfect 10 on 4 different 500,000 square foot Target developments. They are the only developer to have achieved that feat, and no one's been able to do it since. So again, extremely excited to be partnering with Bill and Lightbox Self-Storage Partners. Their current offering, Lightbox Self-Storage Fund 3, is really a rare opportunity for investors to co-invest alongside some of the most well-known and reputable institutions and insurance firms in the world today. So with that, Bill, welcome, and thank you so much.
Sly, thank you so much for having me. I'm grateful for the opportunity. Thank you, RJ, as well. And I look forward to telling you more about Lightbox Storage Partners today.
I might add that when I have brought this up with clients here in the last few weeks, every one of them has said something to the effect of, "Oh my gosh, I've been wanting to do that. I'm so glad you're talking to me about this." So I said, well, I'm so glad I'm talking to you about this as well. So with again, Bill, take it away.
Well, thank you. And I think that what's been fortunate about self-storage is that it really has, for lack of a better way to describe it, had a cultural awakening, as we have seen more and more opportunities that are out there in the marketplace. But I think we all recognize that, America coming out of COVID was truly America on the move. And so as such, we saw, I think, more and more people being touched by self-storage is an asset class. When I used to be in retail, as Sly mentioned, for 20, 25 years or so, self-storage was always the lesser asset class. It's been one that's owned by mom and pop operators. Still to this day, about 65% of the industry is owned by mom and pop operators. And so with that, it never really had that Wall Street or that big institutional emphasis behind it. And so it was just quietly behind the scenes, jugging along. But what has really been, I think, an awakening from our side, if you will, the oak inside the acorn, has been that really, if you look at self-storage from a demographic standpoint, and then you filter back from there and you say, can I support what I'm seeing in the demographics and look at it from a financial metric standpoint? Can I take those two together, those two data points, and make a conclusion that we think is undeniable about self-storage as an asset class? And we absolutely believe that's the case. So if you'll bear with me, Sly, what I'd like to do is try to at least play out that investment thesis. So we believe that self-storage is a life event business. The transitions we go through in life trigger a need for self-storage. But at Lightbox Storage Partners, really that theme that is clearly systemic about all of our transitions in life, really in the data point, right, that we can try to determine whether or not we've got an investment thesis that can be supported. So what we did at Lightbox is we wanted to try to understand whether or not this cultural awareness, if you will, in self-storage had put itself in a position where there are more people using it. And the data here tells you exactly that. When we got into the sector 8 or 9 years or so ago, self-storage was about 1 in every 18 people was a renter. If you look at self-storage this year, it's less than 1 in every 10 or so. So without a doubt, we're seeing growing utilization of self-storage, and we think it's driven by really these 4 diamonds that you see up on the screen. And so if you'll stick with me, I'll try to kind of unpack them in a high-level way. They speak a lot to life events, but really urbanization, I think, was the first big push. As PricewaterhouseCoopers indicates, based on their studies, 93 million people moved back downtown. They say that that's probably the most material change in commercial real estate, if you will, since the interstate system was birthed, right? And people started moving out to the suburbs and building enclosed malls. And so now what's happened, a complete retrench. We've all come back downtown. What you're seeing now, though, is it's downtown and then it's town center living, as people are somewhat in these suburbs, or what I'd call close suburbs to the CBD, are now living in these mixed use environments where you've got office and retail and apartments and all your various services that you need right there on top of you, trying to effectively really become a country in so many ways that lives itself somewhat like European living. The second part is without a doubt directly related to urbanization, though, is downsizing. I think when we were all growing up, the typical house would always have dining room as well as a living room. And if you look at the designs now, according to the National Association of Home Builders, you have a kitchen and what they call a common area. So what's really the metric behind that? That the average home size has shrunk now for 3 years in a row. Now flip that one more iteration and say, well, what's going on with apartments? Apartments is seeing the exact same dynamic. When I was doing apartments 20-something years ago, the average 2-bedroom, 2-bath was about 1,200 square feet. Now, if you look at what's going on with the apartment dwellers in these larger markets, like a San Diego, like an Atlanta, like a Dallas, that 1,200 square feet has shrunk down to about 880 square feet. So, right, smaller the house, smaller the apartment, greater the need for storage. Then you flip it, right, and you think, all right, really, what's the other aspect of utilization? And without a doubt, disruption and dislocation, not to be a negative thing, but disruption and dislocation in terms of opportunity is the other thing that drives utilization. And that's America on the move. We saw that in great multitudes coming out of COVID, as we saw these huge migration patterns coming out of New York and Chicago and LA for that matter. But really now we think America on the move is more about the duration to which people are staying in jobs. Most folks are now changing a job about once in every 2.8 years. So as such, this America on the move is without a doubt something that's systemic. And then the last piece is what we saw really coming out of COVID. When we were in COVID, about 5% of our entire workforce across the United States was working from home. Believe it or not, that number's now grown to 15%. You take all those and you put them in the blender. We think the net result is really a situation where utilization is going to continue to grow as these systemic demographic patterns, these systemic demographic drivers are going to stay present. We like to say, Lightbox Storage Partners, demographics drive outcomes. And I think that's exactly what we've got here. But for this group and for somebody like an RJ Kelly and Sly that's in the investment management business, demographics are hugely important, but really what you want to do is look at analytical data. And you take that data on financial metrics, right? Performance metrics, and you try to stratify and blend it and take it apart every which way you can. And that's what we did at Lightbox Storage Partners to really ascertain whether or not there was something about self-storage above and beyond the demographic aspect. And we believe that self-storage, really the tagline can be number one during the best of times, number one during the worst of times. And the data seems to back that up. So on this slide, we show you 2 points. One is over the 30-year period. Self-storage has outperformed all the major food groups, right? So over the long-term duration, self-storage is at the top of the heap. The part, though, that I think is probably one of the most important metrics in this whole presentation, though, is the one about cycles. And so if you look at any minimum 4-year window from 1994 to 2023, and these are not linear 4-year windows, these are not sequential 4-year windows, these are pick any 4-year window. This can be Clinton, Bush, Obama, Russian ruble, dot-com bust, you name it. Self-storage is one of two, residential being the other, that's in the positive during any 4-year window in which they're operating. Now, that's the top side. But the thing about self-storage that has gotten so much institutional investor excitement and institutional investor interest, without a doubt, is down cycle performance. And the first iteration was in 2008, 2009, during the great financial recession, when everything for the most part was going in the wrong direction. Self-storage rose to the top. So that was the first. And what happened there is you got a lot of that first wave of institutional investor that was trying to come into the space. Again, don't forget, about 65% of the space is mom and pop. So these institutions that come in, they struggle to adequately scale enough product to buy. But the takeaway is that we got WP Carey, Crow Holdings, Heitman, some of the best in breed, if you will, opportunity funds came into the market in 08 and 09. The fund sizes were 250 to 450 million. So on balance, given Wall Street parameters, really pretty small. And that had to do with it all being mom and pop. Now, you take it to today's. And while everybody was talking about Amazon and logistics and industrial, really self-storage during the pandemic quietly jumps to the top again. And this was really what caused the next wave of institutional investor to come. And so coming out of COVID, when self-storage had again proven its down cycle performance, what did we see? Well, really got the attention of the big players. Bill Gates comes in with a $2.3 billion investment. Blackstone comes in with $1 billion investment. KKR comes in with $1 billion investment in the space. So we love the fact that these institutional investors that think about allocating capital properly across a large portfolio of holdings, that they have now all recognized self-storage as a asset class that is recession resilient and has really durable cash flows. Now, the last takeaway, though, is where we sit today. And this was something that we saw coming, we thought 2 years ago. And it's the last remaining huge bucket of capital that's out there that's really not playing in the self-storage arena. And that bucket primarily is pension funds. And so we thought that these Odyssey funds is what they're called. Odyssey funds are primarily these large, lower risk type fund environments that manage pension fund money across the United States. And these are multi-billion dollar pension funds that last forever. Some of them are 30, 40, 50 years old or so. Well, this is the last group that is now seeking an allocation in self-storage. We believe that most of them are going to pick up between a 4% to an 11% in their Odyssey funds. And as such, we have liquidity that's coming into the sector. We have dry powder that seeks to own the sector. And us at Lightbox Storage Partner, as a manufacturer of self-storage, as a builder of self-storage, we are in the perfect position, right, to throw that pitch and let the pension fund be the catcher.
Bill, this all makes sense. I think when you talk about the investment thesis, the fact that self-storage is driven by life events and not so much the market or the economy, and all the different groups that are utilizing it today, it makes sense why you have all of these big institutions making big commitments and investments into the sector. But with all of that investment coming in, obviously there's going to be multiple players within the industry. I know a slogan of yours or Lightbox is that we do self-storage differently. So can you talk about that a bit? What is it that differentiates you? And I'm sure that was a big reason you were able to score that big partnership with New York Life.
Yeah, Sly, in entering the business back 8 or 9 years or so ago, it was our goal to see if we could identify an investment thesis that we did not think was prevalent in the marketplace, that no one else was doing. And if you think about self-storage as a developer, most of the developers are individuals that reside within a certain MSA. Let's say Jacksonville, Florida. Let's say Omaha, Nebraska. These are two perfect real-time examples where a developer deploys some assets, they lease up, he deploys some more, they lease up, deploys some more, and so it becomes a regional play. Very few developers in the self-storage arena develop nationally. Well, us as a retail developer, right, we went with Target and Walmart and the various retailers went all over the United States. So it put a lot of pressure on us to make sure we knew our markets and we understood the psychographic nature of the demographics that were justifying maybe we develop a retail shopping center there. Same analysis in self-storage. However, I do think our differentiated nature of how we go about building our investment thesis, without a doubt, the thing that I think proves it out more and something that we are humbly most excited about and feels like it really gives and lends credibility to our investment thesis is New York Life. They went out with a request for what we call an RFP. A lot of folks would say it's a beauty pageant with 17 different self-storage platforms all across the United States. And little old Lightbox Storage Partners ends up winning the day. And the reason was because we do it differently. And I'll unpack that later for you. But New York Life found that our process, our approach, the granularity and the depth of which we go through due diligence was something that they were not seeing from the other operators. The big win for us, though, is that the New York Life approval it wasn't just a one stop. We ended up getting approved by their big board to invest money on behalf of their general account, to invest money on behalf of their Odyssey fund, as I mentioned earlier, to invest on behalf of their Scandinavian separate account. And now we've gotten approved by their Israeli separate account. So we're thrilled to death. New York Life is, without a doubt, in my humble opinion, a top 3 pedigreed investment platform. And I think what's unique to Lightbox Storage Partners is we are principal to principal with New York Life, right? This is not something where we're working through an opportunity fund or an intermediary, I would say. We are principal to principal with them. For our retail customers, though, for RJ's clients, what's really the significance of the New York Life relationship? You hope it says something about birds of a feather flock together, and there's some credibility that comes with it. But really, I think, if you would, allow me to tell you about these 3 buckets, which I think are elements that really benefit an RJ Kelly client in a manner that's kind of rare air in this sector. So the first is the way we negotiate our relationship with New York Life. We're going to be able to bring in retail customers, RJ Kelly clients, on an equal basis with New York Life. So instead of being subordinate or instead of being behind, if you will, to the New York Life equity, we are shoulder to shoulder with New York Life. So we think that's very rare air in the space. You typically don't see that. New York Life will most likely invest between 90% to 51% of all the equity needed in most of our investment opportunities. So with that, they have the most skin in the game and the most to lose, right? So I think that lends itself to the second bucket, which is the intensity of their due diligence. You know, we have never worked with a group with the resource level that New York Life has. We've done a lot of business with institutional partners, but New York Life has, it appears, a professional for almost every element in the value chain, whether it be environmental contamination to structural steel to you name it. So I feel like we have benefits there that are intangible in nature, but by virtue of doing business with an 800-pound gorilla, you're getting the benefit, right, of all their capability that indirectly inures to the benefit of your customers. The last piece is, I don't know if it's as meaningful, but I think it's got a chance to be really economically impactful, and that's operating cost efficiencies. But really the best way I can describe this is through an example. Our first transaction that we closed with New York Life we went to the market to secure property insurance. And I think as everybody on this call, especially folks in California, as well as possibly those in Florida, will recognize, right, that interest rates have been really challenging, but boy, property insurance has been right there behind it. And so we went out, this asset was in Charlottesville, Virginia, not on the beach or anything like that, but we went to our carrier, which was Chubb, best-in-class player, and got quoted the property insurance we needed for this investment. It was $36,000, all right, about where we'd expect. New York Life went out to their carrier. They were at $9,000. So you see, right, a demonstrable 25% of what we're used to paying by virtue of being aligned with New York Life. Now, the part about show me the math, and we don't want on this type of presentation to get overly granular, but our goal here was to really try to share with everyone on this that's watching the presentation to understand the impact of doing a deal in the traditional methodology of Lightbox Storage Partners, which is still great looking returns, which is still, I feel like, best in breed type returns, 20% or so above IRRs. But if you look at the impact of bringing in New York Life to be effectively 90% of the equity, we are 10% of the equity. We're effectively leveraging our equity 9 times, if you will, that our IRRs really go exponentially to the good. If you think about that, the rarity of that situation, you've got IRRs that are effectively doubling, but you got to ask yourself, am I absorbing risk for that? And it's exactly the opposite, right? You not only your returns are doubling, but I humbly believe your risk is lowering. Right? Protective Life, New York Life has lower leverage. New York Life has greater due diligence capability. New York Life has tremendous expertise. You look at it from the relationship of risk reward, or what a lot of people refer to kind of standard deviation. The risk reward with New York Life is really, really attractive. Returns are way, way up. Risk seems, in my opinion, to be way, way down. Now, there's a second institutional partner that's long-term in nature. I think it's incredibly rare to be with an institutional partner for 16 years and doing business with them on an equity or a debt basis, and that partner is Protective Life Insurance Corporation. They're also very large in size, $130 billion or so institution. They've been around also more than 100 years. They were 113 or so years, I believe, when Teddy Roosevelt was president. So it's certainly not a newcomer. They've got about $14 billion of committed assets under management in the real estate sector. And what's our relationship with Protective Life like? Well, over 16 years of doing a tremendous amount of activity with them, both in retail and self-storage, it gives us access to all types of debt capital. And the way that I would describe it with these 3 buckets, if you will, is the first is the long-term relationship. So with that, trust, faith, confidence in each other has proven itself out. We would not be in business on so many transactions over a 16-year period, right, if we couldn't generate recurring performance outcomes that they wanted. But the second, if you will, is that access to unique loans. And so with Protective Life, we have participating mortgage relationships with them that are very unique and allow us to borrow capital from Protective Life that is incredibly inexpensive. I'll tell you more there in just a second. And the last piece is, again, these institutional investors allow you to be more cost efficient. So with such, when you've done as much transactional activity as I have with Protective Life, we spend de minimis amount of outlay for legal fees. We spend a de minimis amount of outlay on trying to get the loan closed. Let me try to give you a data point, maybe more succinctly. And in our typical close, we're paying about $25,000 in legal. The industry pays typically about $100,000. We get our third-party reports and things of that nature. I think is about 50% of what the market pays. But again, like New York Life, right? Really, what's my mathematical benefit, Bill? Thank you. I appreciate that you have done a lot of work with these institutional partners, but how does it inure to me? How, if I'm an RJ Kelly client, how does this benefit me? And indirectly, you can see under our traditional methodology, again, opportunistic returns, good-looking profile. But the way that Protective Life comes in, we get that same opportunity for equity return enhancement. And so you take New York Life together with Protective Life, and we get 2 levers, if you will, that allow us to generate, hopefully, superior returns. Forgive the hokiness of this slide, But this is really the essence to try to roll it all together. These are levers, or attempting to be levers. And the idea is that when we do a transaction, or we want to close on an acquisition, or we want to close on a development, we have different levers that we can play with that put us in a position to where we can generate different return profiles, thereby putting ourselves in a better position to generate superior returns for you as a customer, with more capital access, with more unique capital structures, with institutional partners that we think are going to increase our reward and decrease our risk.
Yeah, I mean, this is impressive, Bill, to have firms that have been in business for over 100 years each and to be partners with them. I think it's impressive if you had just one of the partnerships, let alone both. Maybe if you could talk to us a little bit more. We talked about how you were differentiated, and that really being why New York Life selected you amongst 16 other firms to really do their self-storage development and partnership. And of course, the longstanding relationship you have with Protective Life. So can you go into more detail about that? What is it that makes Lightbox different?
Absolutely. And Sly, I appreciate the question. I'm grateful for the question. I do think that, the differentiated nature of our strategy is proven out by a New York Life or a Protective Life. But without a doubt, you need to kind of understand it. And I think the best way I can describe it is that so much of what we've done in self-storage harkens back to what we used to do in the retail shopping center business, right? And the first part is big data, harnessing big data to determine where we want to put a self-storage unit is hugely important. And is I think a technological separator, if you will, for us in the marketplace. And Sly, we were doing big data, if you will, and web scraping this information back in 2016, so much earlier than AI and all the new rage, right? But the reason was not because we're anything special. It was because the retailers that we were doing business with, they're special in terms of their data analytics. We like to say down in the Southeast, right, nobody's ever seen a Chick-fil-A that's closed. Right? These guys are fantastic at data analytics and demographic analysis. However, they all do it differently. Talbot's has a demographic criteria that's totally different than a Lululemon, that's totally different than an Anthropologie, that's totally different than an Ulta, you name it. And so in our world, we were so used to having to really carve out incredible demographic information to get that retailer to commit to our space. We took that to self-storage and said, all right, what creates an A-plus location? Well, we know it's a winner. And what we did is we created the population density. We want to be running about 300% more than the typical self-storage operator. Apartment dwellers, we want 40% of the trade area to be apartment dwellers. The key there, Sly, though, is we don't want it to just be an apartment dweller. We want that 2-bedroom to be renting for about $1,850 a month. Population growth, another one, we want that to be about 300% of the national average, which is about 0.07%, and then, 0.7%, and above average incomes. But we take all that data and stratify it, and it tells us, we call it Lightbox Site Finder. It tells us where we think that there's a supply and demand anomaly, where there's pent-up demand to lease a self-storage unit, and then we go. I think the best, again, data point to back up a strategy that we have, and as to whether or not we're all hat, no cattle, right? Whether or not we're all talk, no walk. In this case, the part that I think proves out, in my humble opinion, that our Lightbox Site Finder is working is that 50% of what we've sold at certificate of occupancy. And that in and of itself is an anomaly. That in and of itself is without a doubt rare air. And to explain it to you, that is certificate of occupancy is the day the building inspector comes out and cuts the yellow ribbon with you, right? You are officially licensed to open your building. Now in self-storage, because entitlement and zoning and things of that nature are so hard to secure, if you can go to a real unique location with a high barrier to entry format, meaning that it's really, really hard to get proper zoning, then you can sell at certificate of occupancy. When we got into the business, certificate of occupancy was something that was just kind of getting started. Now for us, it's really become such a big part of what we believe is a great mandate, in that it's an incredible return profile at a very low risk. Because think about it, you have not leased the first unit. You really haven't proven out your investment thesis. However, your location is so dominant that folks like SmartStop, CubeSmart, other institutional players that we've done business with buy your assets. And the number they buy them at, so the last one we traded was in Eatontown, New Jersey. We had about, let's say, less than $10 million in the asset. We sold it to an institutional player for $20 million. So the returns on these certificate of occupancy opportunities are incredibly attractive. Now, the second part of kind of that retail DNA that we bring into self-storage was design prototypes. We like to say, right, you've never walked into a Dick's Sporting Goods that looks different. And the whole idea in retail is always to look at a rectangular box and think about how much sales activity can I generate out of this rectangular box. So that retail mindset is completely opposite of what we found in self-storage. The self-storage biggest players, CubeSmart, Life Storage, Extra Space, were all customized. Every one of their physical plants, if you think about owning $30 billion worth of real estate, and every single one of them has a different format, right? There's tremendous inefficiency in that. Retail, right, is all about efficiency and thinking about that physical plant, that rectangular box, as an ROI case, right? So in self-storage, well, we came back in 2016 after meeting with Extra Space, best-in-class player, without a doubt the gold standard in the industry. And Sly, you mentioned earlier that Target Grand Slam. So we had a good referral from Target going to see their senior leadership. And we said, where's your spec manual? And we're used to sitting down with Walmart that's got a 8-inch spec manual that tells you everything about what the locks look like, right, to the greatest of details, what color are the light bulbs. And they said, you know, we don't have a spec manual. Here's our office and our gate system, and that's it. So that was our aha moment. And so we came back and said, okay, we're going to create the light box. And effectively, the light box is a recurring physical plant that's got a unique, in my opinion, unique steel package and unique design to the unit mix. Disregard that, but it's a repeating process, a repeating prototype, and then we wrap the gingerbread around the outside to match the architectural symmetry of the area that we're in. So if we're in Washington, D.C. or Northern Virginia, we're doing red brick. If we're down in Florida, right, we're doing beige stucco most likely. But the blood and guts on the inside is still going to be that efficient light box. This slide, I think, demonstrates really the essence of what we've done with the light box prototype we've built. So if you look in a building within the industry, there's dead space that's associated with elevators and exit stairwells and things of that nature where you don't have rental income you're generating from it. And in the industry, about 68% of your building is generating income. Well, at Lightbox, about 78% of our building is generating income. And that's the big difference. So if you can see the little green rectangle, that's the essence of what we're trying to do. By virtue of having a really, really unique steel package in terms of how we design the building, very, very simple, and how we do the unit mix layout across 3 floors, that allows us, just like a Walmart or Target wants, to generate more sales activity, more rental activity out of a same finite amount of space as the industry. So that's the second part. And this is what some of the fruits of our labor looks like. As you can tell, probably which ones are in Florida, right? Which ones may be in Nashville, Tennessee. But that's what programmatic development looks like. Through programmatic, just like an assembly line process of Tesla cars, right? Duplication of process, repetition of process, all those things allow for an acceleration of speed and a reduction of risk. If you can't tell anything about the presentation today, just like with New York Life, anytime, right, you can improve your outcomes, i.e. the reward, and reduce your risk, i.e. programmatic development, that's always a winner in our mind. Third element of retail is we integrate mixed use into the bottom floor. And not a lot of folks were doing this when we got in the sector. We saw this coming from the better, I'd say better in breed cities in and around the Southeast that were passing zoning ordinances left and right. They were passing zoning ordinances for typically comp plan overlays or master plan overlays that had been enacted by the city council. And you can imagine for a city council or a mayor for that matter, self-storage is not exactly right. The welcome mat opportunity you're going to get. We don't create a lot of jobs, maybe one. We don't generate impact fees. We just have one bathroom typically. And we don't generate a lot of sales tax revenue because we just sell box and locks. So as a politician, we're not exactly great for the annual budget. So they have all, I shouldn't say, so many of the better markets Charlotte-Mecklenburg County would be a great example. Miami-Broward County, Nashville, Tennessee, Richmond, Virginia, have passed these zoning ordinances that now stipulate that you're not going to do self-storage in my urban master plan overlay. And that's exactly where you want to be. That's where all the population that you want is. But you're not coming in unless you integrate mixed use into the bottom floor. And for us, what we do is we just integrate, typically we call it teaser retail, 1 or 2, 3 tenants possibly. These will be relationships that we've had for 20, 25 years. We've got 3 or 4 Starbucks in our legacy portfolio right now. We'll integrate those into the bottom floor. What it does is really changes the architecture. And it starts to look like, we call it neo-industrial, kind of that Starbucks look. And it makes the mayor and the city council more willing to approve. The best real-time case study I can share with you is we're in an incredible area in Nashville called the Nations, and it's where you've got so many young professionals that have flocked into this area. And it's got incredibly unique craft bars and restaurants and all the things, that age group looks for. Great parks, wonderful setting. But in that situation, we went in 3 times to the city council and got denied all 3 times. We came back in the 4th time with a mixed-use presentation, and we had matched the architectural symmetry of our property with the architectural symmetry of the of the apartments next door. So they looked similar in scope. We got the approval. We sold the asset, certificate of occupancy, about 12 months later. So the last piece of what we do on the retail side, and bear with me, I'm rounding third base here, but the last piece is multi-channel, and it's absolutely, without a doubt, explained with Walmart as being the sample. In our world at Lightbox Storage Partners, we believe the best risk allocation is to do about 60% of our investment activity in greenfield development, where we're actually building an asset. 40% of our investment activity is in a mom and pop acquisition, so it's income producing, or we're converting possibly a FedEx building or possibly a dark grocery store. But if you think about the mindset of it, again, like retail, with a Walmart Supercenter, maybe development mixed use. If it doesn't work, maybe we'll do a Walmart neighborhood market. If it's something more appropriate, Sam's Club. The idea is that we don't just have one horse to ride. We have these different horses to ride where we match the investment opportunity to what the market will give us. And that's exactly what we believe in.
So it still amazes me that for all the investment merits of self-storage, you have an industry that's still largely mom and pop, and that these developers are doing one-off builds. So, I'm really impressed by the fact that you're really bringing an institutional quality or mindset to the industry. I do want to go back to something that you said about you have sold over half of your portfolio at certificate of occupancy. So as soon as you're able to start leasing up, but before you've really seen tenants come in, to put that into context, what are some of the other developers doing? Like what would be their ratio of what they're selling at certificate of occupancy?
Sly, I think that the other development folks, so we've done 50% of everything that we've sold at certificate of occupancy. I think it's a rare transaction, and that you can look at some of the public REITs and look at how often they're buying certificate of occupancy from other developers. I remember a metric, I think, from last year that I think Extra Space did 4 to 6 certificate of occupancy acquisitions out of 149 total, right? So I think it's a pretty rare kind of thing. Without a doubt, it's one of the things that keeps us as a smaller fund, as a niche fund, as a sharpshooter fund. But we'd rather be kind of best in class, best in breed that way, and to put ourselves in a position where, again, generating extraordinary type returns for lower risk. Don't let that theme get lost on you, right? At certificate of occupancy, those return profiles are incredible. But think about the risk, the lease-up reserve that is always part of your construction budget. That's on average about $1.2 million. We don't spend it. And that inures straight to the bottom line because we haven't leased any of the units. We don't have to. We've just sold the building. And the building in and of itself, this is something about self-storage that's that programmatic development, hearkening back to retail again. If I built a retail shopping center in the old days and it was a Target, Ulta, Dick's Sporting Goods, and PetSmart, let's say, we would have better part of 150 different constituents to manage, right? That'd be 3 or 4 general contractors, 30 or so subcontractors, vendors, right? In self-storage, the number of contractors that we have to deploy a self-storage building is 8, right? It's less than the number of people on a basketball team. So if you want to enter into a business where on time, on budget delivery is, where entering a business where it's important to build a repeating widget, what do you want to do? Go something that's profoundly complicated or do something that's got 8 building divisions in it, right? Just 8. So we love that aspect of self-storage. It allows us, if we master the build, to go really fast at a low risk profile and then position ourselves in these kind of markets where we can exit at certificate of occupancy. And Sly, what's really great about working incredibly hard to get that high barrier to entry location is, Sly, the buyers call you, right? We have not had to market a single one of our certificate of occupancy sales. We've had the situation every time where we've got the inquiry that's onboarding, that's coming in to our call center, so to speak, saying, will you please sell it to me? That's a wonderful, right, position to be in as a developer.
Right. And all of these factors has really led to what I've seen to be a very impressive track record from your firm.
And Bill, if you might comment as well, interest rates at this point, the great question is, when's the Fed going to lower interest rates? I'm assuming that's increasing some of the operating costs for the projects and also perhaps the time before a project might sell. So you might weave that into the conversation as well, please.
Yeah, I think that it's worth mentioning to everyone on the presentation that, there are benefits associated with New York Life and Protective Life, and especially a long-term relationship with Protective Life that allow us to access capital that is below where the market's trading right now. So right now, if you were to go out and borrow a typical construction loan from a community bank or even a super regional for that matter, that rate is about 7.5%. We just signed a commitment from Protective Life at 6% for a deal as well. So if you think about it, we are able to access capital about 150 basis points cheaper than the market. And so it puts us in a position where we're taking less capital risk, and we are effectively creating more margin by virtue of long-term relationships with institutional players. So interest rates have moved on us, and it's always incumbent on us, right, to determine whether or not we've got adequate margin and runway. So let's talk about that for a second. The Fed moved interest rates 500 or so basis points, right, over a short-term period of time. And the folks that really got in trouble was a lot of folks that are in other real estate sectors that was utilizing short-term floating rate debt. All right, so we put out a press release earlier this year. Lightbox, we have never done a single floating rate debt deal. We have everything within our entire portfolio is fixed rate in nature, and we don't have a maturity until 2027, 2028. So we're really in a good posture with our debt capital stack. But the part about what's unique about where the market is right now with interest rates moving 500 basis points is, can you as a company still make money and be profitable and be innovative and adaptable to a changing environment? And so what's important to recognize at Lightbox is we, couldn't do a full sweep, figure it all out at once, but little baby bite chunks that we've taken, little strategic steps we've taken in order to create margin, in order to be able to uphold these same return levels. And this is something that was very impressive to some of our institutional partners. So step one was we said, all right, can we put ourselves in a position to lower expenses? And in self-storage, the heaviest expense burden outside property taxes is payroll. That payroll burden is usually $100,000 to $108,000 a year. Well, if you put that on your standard 6% cap rate on your exit, what's $100,000 worth? About $1.6 million. So it's a significant amount of money. What we did is we bought a remote management company 6 months ago. So that is an unmanned remote management operation that is now integrating into our properties right now and will allow us to completely remove that payroll burden. So once again, expenses down, margin has increased. Second thing we did, right, by aligning with institutional partner is our cost of property insurance, right? Gone down pretty significantly. Margins have increased. The third part, I think, about what we've done is really just the efficiency of the Lightbox building in and of itself. we've been able to continue to whittle down on the steel package and continue to enhance the unit mix. And then the second part that's really important, and once again on this idea of adaptability, is we have integrated boat and RV storage on our last couple of builds. That we're not sure we want to do that in a wholesale manner just yet. The demand is seemingly endless. But we have been, like at Vero Beach, we did our typical prototype, but we did about 180 or so boat and RV parking spaces. Now, what you like about that is that you can do parking spaces, outdoor parking, you can do canopies, or you can do enclosed garages with electricity and the whole 9 yards. What we like about that is the parcels that we're buying now allow us to build our 3-story prototype and then have a little residual piece for boat and RV. Again, a little bit accelerant to the pro forma, and again, allow us to give margin when interest rates have taken away some of that margin.
Bill, if I might, you've been so incredibly transparent with us today and just really shared right from the heart. What's to keep? So I understand that there are barriers of entry for you or for other competitors because of what you've been able to do with other communities. And now you have some very significant financial backing and have for the last 16 years with Protective, now even more so with New York Life. But the question I would have is, what's the barrier of entry to keep someone from copying the Lightbox model, taking these things that you've shared with us and saying, hey, that's what we're going to do as well. So talk a little bit about that. And also with the fact that you've got New York Life and Protective looking to you for investing for them, does that take away from the focus? Does that create a possibility where you have so much opportunity in front of you that each individualized returns suffer a little bit along the way? I know that's not the case because I've already met you and have spent time with you. And I know you are absolutely committed to continuing to improve and raise the bar, not lower the bar. But there could be some people out there that are wondering those questions.
And it's a great question, right? We often get the call from what I'd call the Wall Street opportunity funds that we have historically done a lot of business with back in the retail sector to say, we'd like to give you 9 figures and ask you to go put it to work. RJ, we could do that, but it's honestly a race to the bottom. We don't want to do scale. We don't want to do mass. We don't want to build a fund out and try to go public someday. We want to remain because we believe right now doesn't behoove an investor to be long in anything. It doesn't behoove an investor to not recognize the volatility that we're all faced with in so many different areas. So what do you want to do? Lightbox. Our motto, right? Raise quick, sell quick. Raise quick, sell quick. And as you're well aware, we send capital back often when we sell an asset, right? We don't want to store your money. We like to say, right, we send it back. So we're going to take the risk that we can hopefully make you loyal to us when we send your capital back, and you'll invest in the next fund because there'll always be a fund that's open and available. But we're going to take that risk that we're performing well enough to ask you to keep rolling with it. So I think the biggest deterrent of a New York Life or a Protective Life saying, here's a tremendous amount of capital, go out and invest this for us, is scale and mass, public company exit, all those things. RJ, could not be further from our culture. We want to be niche, sharpshooter, best in class, really great innovators, and continue to be in a position where we're manufacturing a unique product and we're selling at a disproportionately large profit to all those groups that are worried about scale and oversupply and demographics associated with, the metro area of New York City. We're just not that. We are very much a little sharpshooter. Our trade area we worry about, right, is a 3-mile donut. That's what we've got to worry about. We're not like a public storage. Second part of your question, which I think is so spot on in terms of, clairvoyant and that kind of success begets success. So as other people would try to emulate you, what protection do you have? Well, the Lightbox Site Finder is protected, right? And so that's our technology that we web scrape a lot of information, and that helps us find those best in breed, but it helps us find those high barrier to entry location. All right, now the part that we're added to there is our CFO just happens to be a Georgia Tech MBA in data science. And so we're hopeful that we can even add some bells and whistles to that. But as you can imagine, as information has become more and more valuable, it's harder and harder to web scrape all that information down. But it's really put ourselves in a position where we're web scraping more. So we as a group are trying to get more analytics in there. Really the idea of I want somebody to design a mathematical model that'll tell me exactly where A-plus locations need to be, and that's our mandate. So I think that's hard to duplicate, right? We're protected there, and everybody on our team signs a fiduciary agreement, which I don't want to be lost on anybody. That is rare in the private equity sector. But every single person on my team is signed a fiduciary agreement that stipulates that unique Lightbox Site Finder and our other analytics can't go home with you. The second part, I think, is that the structural steel side of the design of Lightbox prototype and the unit mix. I think everyone would tell you unit mix in the industry is more art than science, and so we just think it's one of those where we got the science figured out.
Well, as you say, there are 4 things to be aware of. There's data. And with the internet, it's replete with data. There's information which you can derive from that data, but you won't pay anything for that or much for anything. You might pay something for knowledge, and that's what this industry has accumulated to some degree is knowledge. But for wisdom, that is people will pay an almost unlimited amount for wisdom because it's so rare. And I think that's what really attracted me to what Lightbox is doing and to Bill Leitner and your incredible team is the fact that you have, yes, a great deal of knowledge as subject matter experts, but it's gone well beyond that into having wisdom that's inculcated, that's in the box, it's in the water system there at Lightbox.
Well, I appreciate that. I think that that we learned early on with Target as really kind of our lead customer for the longest time and doing some amazing things on the development landscape with Target Corporation. It had a lot to do with I want to fully understand your needs, and then I want you to charge me with can I go build a process? Can I go build a widget? Can I go build a methodology that's going to allow you to do what you need to do, leaner, meaner, faster, stronger. And so I think this element of problem solving and this element of service, or said more succinctly, maybe capitalism with empathy is often a combination for wisdom.
Well, RJ, you touched upon the team. So, Bill, why don't you talk to us as well about the team that you have built at Lightbox?
Absolutely. The team is a function, of track record. And a track record, when I like to share people, how's our track record been? I like to take it to the property level slide. So if I could, the slide that you've got right up on the screen now, this really shows you our development activity. And the takeaway that I asked you to kind of really hearken or direct your eyes to would be that hold period, right? It's 3 years in duration. So I think that's really, really unique in the self-storage or in the entire commercial real estate sector. Typically a development activity in commercial real estate is without a doubt a 5 to 7 year hold. The other part is the compounded annual growth rate, right, at 21% year over year. So you can see, right, we're consistently putting best in breed returns out at the property level. Now, as you mentioned earlier, right, we've been in the fund business quite a while. So we've done 9 fund offerings in this current platform. Many of the first couple were with Protective Life. And the way I like to think about ourselves back then is we were a little mini Blackstone, in that we would identify an opportunity that was innovative and that we could go out and exploit in the marketplace. So first we were doing distressed power centers, distressed big box centers and changing those from B's to A's. Then we started doing open air fashion centers, big mixed use projects. And then we went into grocery anchored retail. So we played each one of those out. And then our investment thesis with self-storage presented itself. We worked on it for 18 months. And each and every year, we challenge ourselves on that investment thesis with all the stuff that I presented to you today. Can we have a disproportionate risk reward with the capital we're putting at work in a manner that we can generate a recurring return profile, right? Everybody doesn't want to, nobody wants a one-hit wonder. Can you walk that walk, talk that talk year over year? And as such, that's what's led us to, the retail channel. So we've done 4 or 5 funds in the retail channel and the self-storage arena, raising money through folks like yourself at Legacy Wealth. And our mandate, again, I mentioned this earlier, is raise quick, sell quick, return quick, right? We don't store your money. We want to have these small knit sharpshooter funds where we're raising capital over 12-month duration. We're immediately putting it to work. We've got all these assets already identified, and we want to exit as quick as the market will give us. If we can continue to find high barrier to entry locations, we humbly believe that we'll be able to exit a heck of a lot faster. So there's that element. And then, give me, Bill, the Cliff Notes version. And this is probably it. If you look at kind of our performance goals that we have for any fund, we want to try to return your capital as we go. And so historically, we've returned a good bit of capital over the first 2.5 to 3 years. Equity multiples 1.4 to 1.8, right? That's under the conventional Lightbox methodology, though. I'll warn you, right? We've now got New York Life and Protective Life that we are bringing to that table. And then duration. We want to be able to stay as short a duration as possible, again, to be a risk mitigant against volatility. So how does all that come about? So it comes about through the proper team, right? And as everybody that runs a business and understands a business, when you are in a position where you realize that you've got a mousetrap that is repeating in nature and that can withstand headwinds or tailwinds, that can withstand down cycles, up cycles, it really starts to sound like, right, a jazz band. And what I'm most excited about right now is that our group has really got a good rhythm in terms of being able to find compelling opportunities and put ourselves in a position where those compelling opportunities are executable at standards that we hold them to. Our group is the royal blue that's on this slide, kind of where we're located. But the meat of our development and acquisition deal making is really Philadelphia all the way down around to Dallas. And so we've got about 9 individuals that are out there finding opportunities for us that are always trying to load that pipeline. And what's interesting about that slide is that that's a lot of people to find 12 deals, right? Because that's the typical size of our fund. We don't have to go out and find 100 different opportunities. We're only finding 12 or 15 to populate, if you will, a Lightbox fund. And so we've got a lot of people. You can see how many stones we turn over in order to find that rare opportunity. It takes that many people, but we wanted to really find that unique anomaly with a compelling return profile before we want to pull the trigger.
Well, one of the things that we see quite a bit right now is people wanting to sell. I've got a client literally waiting for me to get off of this meeting so we can address a building that he's selling, and he's wanting to defer the capital gain by using 1031. Code Section 1031, but he doesn't want to go buy another building. He wants to be out of the management side of things. And that's where it's very attractive to use something that's called a Delaware Statutory Trust, where we can, in fact, help a client sell their building, their real estate, and then reinvest some or all of the proceeds into various different kinds of projects called Delaware Statutory Trust. But at present, the way your structure is built, my understanding is that it doesn't lend itself yet to being able to use the Lightbox methodology into a 1031 exchange yet. But I think you're also working on that, if I understand correctly, because let's face it, if somebody could sell their building and then put some or a good portion of their proceeds into the self-storage, my goodness, what a home run that would be.
We are, sadly enough, as a tax lawyer by training, not by trade, but we're always trying to work on, tax mitigation strategies. And RJ, while the current fund structure is not compliant with the 1031 exchange rules, we as a company have done a DST or 2, and we continue to find opportunities we think will dovetail with the requirements, if you will, of the DST. Now, there's a couple things about Lightbox, though, that I think being a value creation fund that can be somewhat helpful from a tax strategy is, right, you come in and you do get a K1, and on the first 1 or 2 years where it's in that gestation period where we are developing assets, we're really got laying steel and concrete down, right, you're going to have a K1 that'll demonstrate a tax loss. due to interest expense. And then when we open up, we'll do a cost segmentation report most likely and get some depreciation shelter. So that's there. The other tax mitigation strategy, which is a little bit off your comment or two, those the Roth IRA conversion. So we have been successful in doing the Roth IRA conversion. We will do one in 2025 and put ourselves in a position where if somebody's coming in on a converted basis, that we're going to go out and get our assets valued by an appraiser. They'll be fully documented and licensed and meet all the thresholds, and we're going to do it properly. But we are going to welcome people that have a Roth IRA into the fund for sure.
That is a very, very clever idea. And for anyone who's watching this video and wants to know more about that, that is not something you want to try to do at home. But you can reach out to us at Wealth Legacy Group or send me an email, rj@wealthlegacygroup.com, and we can help you unpack that. But it is a powerful, powerful idea about how to move money out of an IRA into a Roth IRA, but get a discount on the amount of money that you're sending over. And yet, after the several years of maturity, then that value returns and the money that's inside that Roth IRA now is all non-taxable. So powerful idea. Bill is so delighted that you brought that up and that you are in that space as well.
Bill, I just have some questions regarding the fund so investors know what to expect and what to be thinking about. So just quick questions. An investor coming into Self-Storage Fund 3 today, which is available now, what can they expect in terms of a hold time? How long is the money going to be invested?
So our goal continues to be the same, that we would anticipate it being 4 years from here. The nature of interest rates and the market right now are not slowing us down in terms of finding distressed developer assets that we think are very compelling, and then our ability to access capital and do such is not impacting our business model whatsoever. So we're going to stick to our raise quick, sell quick, and continue to be in a position where we're going to try to recycle through these funds, I would say 4 years from today.
Yeah, perfect. And that's certainly on the shorter end of what we see for development funds. Now, any distributions that the investor can expect?
So, we do not pay a dividend necessarily, all right? But I think there's, without a doubt, a sense in my mind that Lightbox has liquidity elements to it that need to be recognized. So if you think about on the last couple of funds, in the first 12 to 18 months, we returned almost 30% of the investor's equity through sales. And then kind of 2.5, 3 years in, we returned almost 70%. So it's not as if you're going to put $1 in Lightbox and then 4 years later, you're going to wake up and try to determine how it's done. Right. We intend to return capital as we go. Once again, we take the risk as to whether or not your client will stick with us. We have a 5% loyalty discount if you keep rolling with us. But our idea there, Sly, is a couple of things, right? It keeps us on the treadmill. We have to perform. We have to exit. We have to put ourselves in a position where we're creating gains. The other thing, Sly, that's important about being a small niche fund is we can't live off asset management fees. There's such a misalignment, I believe, with clients in the space that are investing in a very, very large fund where management gets misaligned with the client. Right now, with Lightbox being such a small player, we're not in a position where we can settle, if you will. We've got to continue to perform in order to be able to create the gains we need to pay for our platform. So that's the plan. And I wanted to share something on the screen right now just to give you a sense of kind of some recent activity. We just opened this asset in Lake Mary, Orlando. It's a recent opening for Lightbox 2, our fund that we're just wrapping up right now. It was $500,000 under budget and is representative, if you will, or demonstrative kind of the Class A asset that we build. What I haven't had a chance to mention today is that, Bill, who are you selling to? This Lightbox prototype is great, but is it structured and built in a manner that the institutional folks want it? And the short answer is yes. KKR is bought from us. CubeSmart, Quadrille is a Canadian pension fund. Prime Storage is a $2.5 billion company. So the billion dollar top 10 players have all bought from us and bought the Lightbox prototype. The second part, Sly, about What's the opportunity out there for investing now in Lightbox 3? Well, we're not going to rest for the weary, right? We've got an investment opportunity that we're closing here in the next 30 days or so. It's located in Berlin, Maryland. This is an asset that sets up kind of exactly like we like, undermanaged. They're not selling tenant insurance. They don't have search engine optimization and revenue management systems, all the technology that we bring aboard. It's located in a city called Berlin, Maryland, has disproportionately large rates, if you will. And it's a feeder, if you will, into Rehoboth Beach and Ocean City, Maryland. And so we love our market positioning there. The other part, though, that we haven't closed yet is the Protective Life, though, at least has given us the initial green light on doing this underneath their initial structure. So what I like about it, Sly, if you remember those IRRs we showed early in the program here, the first deal seems like it's going to be a Protective Life capitalized deal. So that equity that we've got to play with will hopefully be coming in an environment that looks like it's going to have a greater return opportunity by virtue of aligning with an institutional partner.
Yeah, so it's exciting to see that you have the first planned asset for Fund 3. So I guess I'm curious to know, when investment money comes in, are you looking for a site at that point? Are you putting it through the site finder? You mentioned that there's going to be 12 to 15 assets potentially in this fund, about 60% of that being ground up development, the other 40 being acquisitions. So do you wait to bring in investor money before you start looking for those sites?
So I completely the opposite. You know, in our world, the entitlement and the zoning process, but given the difficulty in the markets we're operating in, will often take 2.5 years, right? And so with that, we have to always be finding those opportunities and pushing them through site plan approval, building permit, things of that nature, trying to get it through that entitlement process. So for us, we are always have a pipeline that is kind of 3 times the size, if you will, of the current offering, because those come on through and they gestate at different durations. So right now, Lightbox 3 has got everything identified. If we had all the capital raised, we'd put ourselves in a position where we would close those over the next 6 months or so. We'll manage that process as it relates to entitlement and zoning. Acquisition, Sly, the only thing that we can't manage those durations as quickly, because those are typically shorter term closes. But as you can see, if we want to close something, we're going to use New York Life or Protective Life Capital, bridge any opportunity we need by virtue of those capital partners, and put ourselves in a position where we're not walking away from an opportunity that we found.
So, Bill, fantastic opportunities for our investors, our clients. I got a question, 2 questions actually. Is there anything that we should ask you that we haven't asked you so far? And the second question is somewhat related to that, is what keeps you awake at night? I realize there's the hunting dogs that are next door that are baying or something, but is there anything in your life in terms of this investments and such that keeps you awake at night?
You know, I think that somebody like me is a type A hard charger, probably workaholic as well. The things that I'm always working on is work-life balance, right? Married with 3 children, and time flies. So that's a part of the, getting overly personal with you. That's a part of it. But on the business side, the question that you would without a doubt ask me as a self-storage developer and acquisition and sponsor, would be, do you worry about oversupply? Because if we did have $1 billion or $2.5 billion like Prime Storage has right now, and you had to go out and do 10 deals a month, then there's without a doubt areas North Dallas, downtown Seattle, all the places that we monitor that have oversupply issues. For us, though, RJ, we just have maintained our small niche aspect in order to not have to entertain anything other than a 3-mile donut to determine whether or not we've got an oversupply issue. So there's that. Is there next question would be, Bill, is there a technology disruptor, right? Like we've seen in other industries that have just come in and wiped it all out. Think about what we're talking about in AI right now, right? And just these incredible changes that may be occurring. I don't see one. We thought the pods, where you effectively have the trailer that pulls up in your driveway and you unpack it there, or you pack it in, they carry it off site. We found that to not be that big of a distractor, if you will, from our customer, because our customer, believe it or not, has to get more access to their storage unit than a lot of people realize. For us on the residential side, we think of grandmom's heirlooms, right, or furniture that we're saving for our children someday, and we put it up. We don't think, well, really the rest of the world is the restaurant caterer, is the pharmaceutical sales rep, is the subcontractor that hangs, LED TV station, things of that nature. They are constantly accessing their self-storage unit, once again, hearkening back to the reason why you got to have a retail type location with convenience and efficiency. They want to be close to their ability to get to those things. So with that, we don't see a technology disruptor coming at us that looks like it's going to come in and disrupt the sector. Demographics are not going to change. Life events are not going to change. What keeps me up at night beyond that, I think I probably have all the same aspects of wanting the world to be less polarized and more commonality, but that's probably for another day.
Well, this has been just delightful. Certainly, we're quite a ways into this, and so thanks for anyone who have been with us this whole time. Great, thank you for your patience, and I'm sure you, like me, were just wanting to hear more and hear more and hear more. So there may be another Bill Leitner interview part 2 that will come with, but for now, Bill, thank you so much. It is such a pleasure, and I'm so delighted for our clients to be able to access now Leitner Investments with the self-storage space that it has been for decades. Such a consistent performer in good times and in bad times, but you've taken it to a whole nother level, you and your team at Lightbox. So congratulations. Super excited to be able to work with you. Sly, as always, Access Capital has opened the doors to the most amazing suppliers and sources, which are, again, I appreciate as an investor, and our clients do as well. So with this, thanks so much for being with us today. I'm RJ Kelly, Wealth Legacy Group in San Diego, California. You can reach us at the number on the screen, 858-569-0633. That's 858-569-0633, or info@wealthlegacygroup.com. And with that, stay tuned. If there's a topic you would also like us to do an interview or a webinar on, just please reach out to us. Happy to have a chat. And if you just simply want to have a conversation about your situation, well, it has to do with your wills and your trusts, your insurance, your investments, these kinds of things as we're talking about, taxes and estate planning. We're not attorneys. We're not CPAs. I do have a number of advanced degrees, but we are well connected, as you can see from the 2 that we've got on screen today. And so we can simply sit down, have a complimentary conversation for 20 minutes to talk about your situation. And what could we suggest for you, whether you hire us or not? What can we suggest to you that might be helpful for you to be able to pull together the loose ends on your planning? You find this all the time. So with that, God bless. I'm RJ Kelly. Thanks so much for being with us. See you next time.